What is going on, everybody, and welcome to another weekly update, but a New Year's update. Yes. If that sounds like something you're interested in, consider subscribing because I do provide daily and weekly updates to get you prepared for the day and the week ahead. But this particular episode is a little different as we were kind of go over the past year and what we are kind of looking at going into the future. Or something I like to talk about a lot is to not only go over the week, but we need to kind of understand, at least for the next couple months, what could potentially play out. Now, if you've followed me at all to this point, you kind of know that we are looking at specific things. Again, there is a lot of noise out there, so it's really trying to decipher through the noise and depict what actually makes sense in building a thesis. That's essentially what I talk about on this channel, is having a thesis and then looking for data points to justify your thesis. Again, the problem here is also that there's a lot of data you really can't go off of, and this is why I point towards earnings. This is why I look at other particular things like savings rates. I look at credit cards. I look at things that are building into my thesis about a potential bigger catalyst at hand coming into the new year. But before we get into that, let's go ahead and talk about last year. Last year, my expectations for last year coming into the new year, I was expecting things to have you always come into a new year expecting things to kind of get into a normal cycle. Typically throughout a year that there's the beginning of the year, you have the Christmas rally, and the market kind of dies off till the middle of the year. Then it picks back up and starts to run towards the back half of the year. That's how a typical cycle normally works. Um, you have many ups and downs throughout there, but essentially you're talking about a bigger time frame. When I'm talking about this, the market does go up, the market goes down every single day, every single week, every single month, but you get bigger. The overall arching move is just like a quick roller coaster move, up, straight down, and then up again. Right, that's your typical normal cycle. This year, obviously, we started selling, and I was looking for that turnaround towards the back half of the year. A lot of data points were looking bad. Inflation was looking really bad, um, and trying to justify if it was transitory. Because I think at one point, coming into this year, we weren't expecting the Russia invasion, right? That just wasn't going to happen. We didn't think that was going to happen, and so I thought there was a chance things could be temporarily transitory, that inventory and stuff would have come back had it not been for um, essentially the war that kicked off, right? That put more strain and introduced a lot of other things. There's no way of really knowing, but I think overall, yes, we would have still had inflation issues to an extent and stuff like that. But the supply issue that we were having over the past 2 years of the pandemic would have been a lot different. And all we saw was the market go up. And this year we had a bear market, and I think it was just the beginning of the bear market coming into the back half of the year. A lot of things started to make more sense that things would start sliding. We saw a lot of big corporations, Tesla, Apple's, Google, Amazon, do stock splits in the middle of the year. They were anticipating something a lot worse happening. And then you did have Elon call primarily almost the top coming on inflation about roughly towards it was around the fall is when he called it. And that was roughly about when we saw it, when it hit 9.1. And this is when, the Fed started hammering rates in the beginning of the year. And what's really scared the market and caused this downfall throughout the year. And, um, and they continued to do that all throughout the year. Then they started towards the back half of the year. They started hammering 75-point basis moves. We had four 75-point basis moves back to back to back to back, and then and then we had a 50-point basis move to close out the year. So this kind of sets up for, and I've had this thesis coming into all this year that there's going to be a bigger issue that's going to occur next year. Now, given the last year, you still had your administration telling you that we were in a growth recession, or not even in a recession. They tried to redefine what a recession was. You had many other data sets, right? And the biggest thing was understanding that inflation did come out of used vehicles. It did come in used vehicles hit one of the highest points ever this past springtime as well. And so you saw that disconnect, that you saw destruction demand towards the back half of the year, and realizing that people started purchasing basic necessities on credit card and started selling a lot of the assets that they accumulated over the pandemic for fractions of what they bought them for. And this hurry to liquidate and get as much cash as possible for potentially what could be coming up next. And so my thesis has been building towards this, that a bigger catalyst is going to occur um, coming into this year. At what point, again, it's hard to tell. Something I've kind of talked about to this point is you can't tell how many assets people have accumulated. We have to understand that coming into this past year of 2022, that people paid off a lot of credit card debt with the free money that was handed out. We were looking good, but now people again racked all that debt right back up because now they're just trying to stay afloat. So it puts us right back into this hole, and at a 2.4 savings rate, which is again not good. I talked a lot about as well how inflation was the big pivotal point all year, till essentially that last until we started seeing a real gradual decline in inflation from 9.1 down to the 7.2 now, I believe, is where we're at. And so that is helping a lot. Again, the Fed is still gauging for at least a 4%. They know inflation is going to be high. They would still like it at 4%. The question is we're going to have more inflation coming up, and then you're going to have inflation reports every month. So that's nothing new. I don't think they're going to always have weights until it gets down to where the Fed want it to be, which is, I mean, we like to have it around 2%. But I don't think we're going to get there. They've even said, again, inflation may be a little high. Maybe we hit 3, maybe we hit 4, and we keep it there for a little bit. But I think once we get there, you're looking more for a gradual pivot in the economy. You have to understand it's not just the American economy. The world economy is suffering a lot. We saw that over the past year with Japan messing with the yen in their bonds, and the Bank of England have done the same. These world economies, right? They're trying to keep up with the dollar, and so in this debt system, right? They have Japan has some of the most. They hold a lot of bonds, and essentially, you have to understand the bond market is essentially the infrastructure of this whole debt system that we are currently in. And so, with that being said, again, the bonds only move. You have to understand the bonds are very hard to define. Most people, nobody can really define what the bond market does. But all we do know is that the bond market manipulates the market in general, and there's a lot of volatility within the bond market. And when you see this manipulation of China, the Japanese governments, trying to hedge, essentially hedge 50 points both ways. And when you have the Bank of England manipulating their bonds so that to try to keep up with the dollar and to try to stabilize their currency. And so this, again, is you're introducing tons of volatility into the market, trying to purchase so that you can keep the pound up or you can keep the yen up. And this in turn affects all markets. So being said, that kind of sets us up for where we are now going into the new year. The new year is going to be, I think it's going to be a very interesting year nonetheless. I think we still haven't seen the end of pain. I think the next 6 months are going to be really trying. But again, you have to understand, and I also understand that the stock market can break away from the economy and what's going on in the world. The stock market can go up and hit all-time highs before the world even recovers that quick. So I do believe we will get back to a normal cycle some point the back half of this year, but I think I'm still aiming for that normal cycle, but I think we still need that crater move from what has been happening. We have to understand too that there's been a lot of layoffs. People are coming off of severance packages. We really haven't seen the impact of that yet, of that hit yet. We're having some people come off, and so we're starting to see some of those numbers. I think in February, March, April, May, you're going to start seeing more and more of those unemployment numbers of these people rolling off. There's going to be more layoffs, so we have to anticipate that. We have to know that's what's going to happen until the Feds start actually pivoting and taking rates off. Will this change? But the thing is that they're not going to pivot. They're still projecting I think another 22, 25 point basis moves, if not another 50 on this next one in February. Could potentially happen. Again, they want rates down further than what they're at. That's great that we've had this gradual decline. And one thing for certain is we don't want it to start rising again. That's the last thing we want, is inflation to start rising, because that's just going to put a lot more strain on an already broken market right now. So with that being said, you still have to be mindful that we are coming into the winter months and the dead of winter. There's still the struggle with Russia and Europe and gas. So we have to understand that could be a real issue still coming up. And inflation could come back. And that's the scary thing about inflation, is it could start climbing back. And so this is why you're having a lot of front run Fed with high rates. And then we have to understand that even when we stop increasing rates, it will essentially sit for a prolonged period of time at a high rate. So that way they ensure inflation goes down, which means that, again, there's going to be a lot more layoffs. There's going to be a lot of people hiring until they start reducing rates. And at what point, when is that? We're told 2024. Again, it really depends on how the market plays out this year. There's a lot of communication, which is a lot of consolidation and jumping around. So we're going to have to see how this year does play out. But this first 6 months, I think is going to be critical. I think we could potentially have some. I think we're going to open up, to be honest, on Tuesday with a big move. I think the market is ready for a new year and hopes for a new start. Whether that's up or down, it'll pick a direction. But you still have to be aware that a normal recession is 43%, and we've only hit about 27. So we could still drop quite a bit, and that's just an average, right? It could be less. We could have hit bottom. We won't know until time passes, but it could get a lot worse. So we have to keep that in mind. Risk management is extremely important. And majority of investors are looking for further out, and if that's who you are, and I think you're still going to have to look at least a couple of years out for things to potentially run. But I do believe when we do come out of this, right, the 1920s are talked about a lot, about that cycle and how we are kind of in the same cycle, and how that boom and then bust, and we just exploded, right? And that could be a strong possibility of what happens here. And this is kind of the things, I know people hate talking about the bear market, but these are where things are built, and you can do great things and generate wealth changing numbers from times like this, because of the fact that there will be a huge boom after this. It's just positioning. If you're DCAing, which for me, I've slowly started on some particular things. I was a lot of cash for a good majority of the back half for a good majority of the year. And to be honest, I was intraday trading. I think I had a couple swings pretty much all year, but it's been pretty stagnant for the most part, because just the market is not in a good position. But again, you position yourself right, things will be in a great position after this potential boom that we could be having after this bear market. The question is when the economy folds, the consumer folds, where is that going to put us? Are we going to get one more very long, big leg down? Is kind of what I'm looking for that pivot. Like, okay, this is the bottom, and then things start running back up. Is what I'm thinking. We're definitely gonna have to see how that plays out. Again, I'm really watching the normal down cycle in March and April, and I want to see if that's when things kick off and things just get really bad, and then we could potentially hit peak bad territory to start recovering in the back half of the year, and then hopefully maybe get some rates reduced by 2024, maybe even by the end of this year. I think you're gonna have to see some big changes for it to be this year. But again, once you introduce hopium in an environment like this, it's going to be extremely potent. So you have to be mindful of that. That's why it is good to start DCAing. I've been in and out thinking about potentially DCAing. But at this point, I think, a lot of things have been knocked down to 75, 80% from the tops. Now, that's one thing to understand too when you're looking at these stocks, equities, whatever you're looking at, even if it's crypto, is to stick with the best, the most well known, because the problem being is that a lot of things aren't going to make it out. A lot of companies aren't going to make it out. A lot of cryptocurrencies aren't going to make it out of this current environment. If they haven't already died off yet, there's still one more check on everything, one more round of checks before this thing gets corrected, in my opinion, before we go back to a normal cycle. And so, again, we're going to have to see how monetary policy plays into it. Again, monetary policy is still going to be very pivotal until they stop raising rates. Once we get essentially at that flat rate where we just stop increasing and we hold, that could be pivotal enough for the market to just start running, is what I'm thinking could potentially happen, because people will hope that the next move would be is to, that would essentially could be, I guess, defined as a pivot, because the next move would be start rolling off rates. And so you might get people buying in a lot at that point. And then going back to the consumer coming into this year, again, we got earnings here in a couple of weeks. We want to see credit cards. We want to see how the banks are doing. The banks have already kind of threw it out there that things are going to get bad, which could be concerning. Seeing negative GDP. Again, the market isn't going to price in all this stuff. There's no way the market can price in what they don't know. They can attempt to price it in. A lot of it is getting absolutely crushed. Even if you want to go back, I believe it was 2001. Things lost 70-80% of their value, right? And you have to be mindful that this stuff happens. We are in a very historical time, right? The market doesn't normally do this stuff, but this is, again, there's a lot of fear in the market. And like the good old Warren Buffett, it says all the time, right? When there's this much amount of fear, it's when you buy. And so this could be the year for the big turnaround. I think it will be a big turnaround. It's just gauging when. And my window isn't until probably roughly around that back half, the normal cycle. When you're looking at July towards the back half of the year, that we could potentially hit rock bottom, if we're going to get a rock bottom and then start recovering from that point. I'm not going to say it's going to be a smooth or a V-shaped recovery. I think a lot of people still think the market's just going to V-shaped recovery like it did out of the pandemic. Again, there was massive amounts of money printed at the time, and so it helped. You're not going to see that again here. So it'll be interesting to see what happens moving forward. And again, you have to understand there may be new data or new something else comes out. Maybe we get new checks again. That's going to cause another issue. You don't want another big boom and then another big bust again. Maybe some people do, maybe some people don't. That accelerate things a lot, but we've already printed a ton of money. And then we got CBDCs rolling out this year as well. So got got a lot of interesting stuff that is coming and could change stuff dramatically. I think cryptocurrencies are going to play a big part in this next windup too. So, with that being said, coming into the new year, this is what we got. We're going to start looking at week events. Monday, obviously, market is closed. Wednesday, we do have the FOMC. I think normally these don't have tons of weight, but given the certain circumstances, sometimes these do. And I think this particular Wednesday will have a little bit more weight on the meeting notes because it was a very pivotal. It came out with information on when the pivot could occur, and that kind of crushed all hope that we had. And so if these meeting notes can give us more insight into that, it could be a big change into essentially bring a lot of volatility in the market on Wednesday. I think it very well could. And then Friday, something I've been talking about, non-farms typically don't hold a lot of weights in a normal market. They don't really matter now. And now that we feel like we've got inflation potentially tackled, non-farms are going to have a lot of weight, in my opinion, because we're trying to gauge where they're at. We're trying to gauge where that fear level is. We want the consumer to come back, right? If there's no demand, there is no market. So we want that demand to come back. And that question is when does it come back? And that's what we're dealing with now. And so we'll continue to see that because we'll continue to see the consumer get crushed when more liquidation happens. People start liquidating their homes. To understand again, I think it's like 65, 70% of people's wealth. I think it's even higher than that is held in their home, and they have to liquidate. Some people have there's a lot of rentals out there too. A lot of these institutions, this is something you have to keep in mind too, is a lot of institutions like BlackRock have been buying real estate over the past year, right? And if they're all about the bottom dollar, and so if for some reason they feel that they're not going to be making their money on these homes, they will sell them and shift their money, and you're going to have this wave of supply of houses, and then people that need to liquidate so that they can try to survive and get out of this cycle, right? They're going to have to sell for fractions of what they thought they could get because of the fact that BlackRock is now selling on top of them selling, and BlackRock just wants to get out. They don't care. They will shift that money however they can, and if they can get it at a price and just liquidates. At this point, you're looking for liquidation. And when you are looking for liquidation, the market that has very little liquidity, you're going to have people selling stuff at fractions just to get cash back in their pockets so they can survive. That's the next step. That's what I've been talking about and what we're worried about. So non-farms are going to matter. That kind of data is going to matter. So, upcoming events, again, monetary policy all throughout the year, February, March. I think in June, I think these 3 months are going to be the biggest months to watch monetary policy. And then I think after that, we're just going to get flat rates for the remainder of the year. Again, unless inflation starts to creep back up, that's going to be an issue there. Savings rate coming into this year is again sitting at 2.4. So again, coming from pandemic high of 33, so we're doing so good only to get crushed again. So, and then watch list this week, again, a little bit more volatility. Again, I think we could potentially be a little explosive this week with the data that we got coming out. New year could be, but it is a short week. So we're going to potentially have low volume still a little bit until we get a full week. So we might not see that. Whatever move happens this week could be corrected by next week. It's a very strong possibility because of the low volume. So just be mindful of that. I think there's going to be some great moves again coming into a new year. You provide that new hope. And so I think either way we go, I think there will still be a lot of movement coming into this year. So that is being shown in the prices here, as a lot of these have jumped up quite a bit. Not a ton. SPX jumped up about 10. Tesla jumped out a couple points. Apple jumped up 1. You can tell it's going to be big because these ones don't typically jump $1 or $2. They're jumping about $1 or $2. So there's the market's looking for some volatility this week. So again, non-farms are going to be big. Again, these FOMC meeting notes are going to be important because we want to know where that pivot is at. If there's any insight into a pivot that is going to provide hopium back into the market. So you have to be mindful of that. The problem is, again, on timing. If that hopium is introduced before the consumer can recover and that demand comes back, you may get a pump only to be left in the dust, and this thing could potentially turn around and crash, right? Because of potentially massive bankruptcies and foreclosures that roll out. But again, it's something that's very hard to judge because you can't tell how many assets the consumer has, right? There was a massive amount of accumulation in assets over the pandemic because of fear of what was going on. And then now everything's liquidating to get whatever they can for it. So again, it'll be a very interesting. This is the time to accumulate. If you can accumulate as much stocks, real estate, whatever you can right now, because we're in that boom cycle. It's really going to boom, in my opinion. But again, I think we are. It's still too early to tell about a boom cycle. The stock market always leads first, and then the housing industry always is on the back half of that. So, again, I think that's what we were watching, and just be mindful of that. So, with that being said, technical wise, I think we could still pump. This is something to really watch out. We've broken the weekly here at the 50. We tried to attempt to retest it. Problem is here, we need to really keep an eye on that 3,900. We could potentially break back over that. And again, you have the 20 EMA. This is the move I'm talking about here. Is this 20 EMA monthly up here, the purple line up here? We did break that. We haven't retested that. I think if this is kind of what I've been talking about, this rally, if we can get any kind of rally coming into this new year, I think we could potentially revisit the 4K mark. At that point, if earnings are bad, which I'm expecting, it could drop us back down, and then we'll kind of float around. That kind of puts us right at monetary policy. And then at that point, I think we could find ourselves right here again at monetary policy, which is February 1st, and then that will dictate direction up or down. Again, I don't see us. It's hard for me to really see new lows unless there's information that yes, we're not in actually a recession, but we're in a depression or something like that along those lines, or start seeing bankruptcies or some black swan comes of the consumer being crushed, which there's a lot of different black swans that can come from that. So just be mindful that if we get a black swan for maybe even banks start folding, whatever the case is, we could just get them at a random drop. There's a reason why we've been holding down here and we haven't been shooting back up to all-time highs. But in the short term, what I'm looking at to try to keep it. This is why I try to keep stuff short term. Don't try to project too far into the future. Kind of have an idea, but kind of know that things can sway pretty quickly. So just be mindful that again, I'm technical wise, I'm kind of looking for that retest of the 20 EMA monthly, roughly up here. Maybe our Christmas rally gets us up here. But then again, I think that could be corrected very quickly on some other bad news, that natural roll-off cycle that I was just talking about. And then maybe some other black swan plays into that, and then maybe we see a new low. Again, we have to also understand Goldman Sachs is talking about us seeing a low of 3K, which is way down here, which we haven't seen in a long, like pandemic lows. Is what they're talking about. So they're talking about 3K. So they're talking way down here. And this is right the pandemic right here when the pandemic started. So they're talking about right here retesting this pandemic, which I think potentially I've talked about roughly around the 3,200. I think if we do drop, it would be roughly around here, around the 3,200. But Goldman Sachs is saying 3K down here. Some people are rejecting a little lower than that. It really just depends. In my opinion, again, I think 32 is probably too low. And then when we start rocketing back up, I think there's innovation. I think we are not in the 1920s, right? We have innovation, so we have technology. We have a lot of different things. Yes, it sucks having people getting laid off, but we have AI and everything else that is making a huge difference in cutting costs and everything else. So during trying times, people will cut. At first it's the layoffs, and then it's trying to be innovate as best as possible, and I think that's what we're seeing. And then we'll get a boom cycle because of that. Not saying, and this comes on the whole gig economy and how the world is changing. Um, right, these industrial revolution and everything like that. These cycles change the whole economy, and we're about ready to see that again. And so, and again, it's been accelerated by the pandemic, by the war, everything else that's going on. So it'd be interesting to see what's going to happen over the next couple of years and how this ultimately plays out. But again, bottom. I'm not going to call a bottom on this. This very well could be a bottom. It really just depends again on timing of everything. What new news we get. This is why I do daily and weekly updates, because it can change. It can change a lot. So the dollar is actually quite interesting. There is again really strong monthly support here, roughly around that 102. We're getting very close to this. If we do break this support, I think this thing could really flush pretty heavy. But I'm expecting a big bounce roughly around here. We're getting really close. And again, if this dollar starts ripping back up, that's going to put a lot of strain on the market. So just be mindful of that. So keeping a close eye on the dollar. Bitcoin, again, hasn't moved. There's no real reason to move right now. This could be accumulation, strong possibility. But if the market starts selling, the market's been running in parallel, or Bitcoin's been running in parallel with the market. So if the market takes another huge dump, you can guarantee that Bitcoin is probably going to do the same thing. I think we still haven't seen a low on Bitcoin. I think we could potentially come close to the 10K mark. Really just depends on time. Again, timing is everything on how much sell pressure you're going to get, and again on whatever event that affects. Right, if there's some bigger event, which I think there is getting ready to unfold here, will really determine how much sell pressure we get. So Tesla. I do really like Tesla. Can't believe it hit a low here of 104 ish, 104. So I'm going to start accumulating. This thing has been really disconnected from the daily. So again, expecting a really harsh uh, bounce off this 148. Again, I think if we do get earnings rally, it goes up to 148, gets rejected pretty hard. Again, this EMA is going to move down as we get a new day. So it might not be 48. It might be a little bit lower. Maybe it's 140 moment. It's 138. And then reject off that. Again, big thing to watch is when it starts hitting and can't break and consolidating. That could be your time to get out, because this thing could be rolling over for the next downturn. So kind of watching that again. I want to see how this earnings. I think we'll still get some sort of earnings rally. It just depends on how much. It's kind of set up with Apple as well. See if this thing can pump back up to potentially 140. Again, we're going to deal with the same thing. News comes out, meaning monetary policy, whatever the case is, and then we start selling off again. But those are the two I really want to watch coming into this year. Tech-wise, again, I think innovation is going to be extremely important. Tesla is still one of the best companies, even though with all the drama going on with Elon. But nonetheless, BA, again, very overextended. It's been bouncing roughly around this 200, looking for this thing to turn over here. And again, this is value and financials have been holding up the market because tech has been suffering. So if this thing does start to downfall, going to be in some big trouble. So really watching that, see if it can break out. If it does break out at 200, can be a positive thing for the markets. Otherwise, this thing, 50% is 40 points, which is quite a bit. It's a big drop for BA. So I'm going to have to see how we do going forward. The banks, let's see here. JPM could be a lower high here, a break and retest. Let's see. Hopefully it can continue up. It needs to break back over the 139 for this thing to keep running. Can go up to 144. Got a couple other 155, and then could potentially top 169. Again, bank earnings could be bad, and if this thing flushes, again, that's what's going to hold the market. You got a huge gap here to fill. So that is what's concerning with JPM. GS, again, same thing. Holding support. You don't want it to break the 343 here. If it does, it could be coming down. Support at the 324. Another support at the 283. Bank of America, there's no point really looking at Bank of America after its comments. It's pretty much gotten obliterated. So it'll be interesting to see. what happens during earnings here, especially with all them commenting and the CEO of Bank of America essentially saying a negative GDP. So there's probably something he's seeing in his report that's going to come out pretty soon that could potentially crater this even more. Maybe this does break this floor here at $30 mark and continues to sell off. You have to understand, even though it's very overextendedly sold, it can continue to sell. So just be mindful of that. Just like I talk about the overextension, yes, it will at some point, but there's no point guessing when that is. It's waiting for it to happen because sometimes it can keep pushing. We're going through a very historical time, so you're not going to see normal moves. So you have to be mindful of that. And this is why this whole market's been confusing, is because you haven't seen normal moves. This is not normally what happens. And these cycles don't always occur either. But you just came out of a very historical pandemic. And then, and now getting potentially ready for a big boom. But again, I don't think we've seen bottom yet. So if that's being said, we've made this about close to 40 minutes. So if you have made it this far, I appreciate you. There's a big year, came out of a big year, big nasty year of the bear market going into potentially a big boom. So excited for that. It's just accumulating and adding at this point. Again, expect things can go a lot lower, right? Um, and risk management is everything. You have to have a plan. You have to be able to, can I go without this money for the next 5 years on every asset you're looking at? Is this a commodity or an asset that somebody is aware of? The average person could tell you what that is. I think I've always pushed that. That's extremely important in markets like this, because a lot of these stocks aren't going to see those all-time highs like they did before. And people start their money in the stocks that matter. And when we start going into that boom cycle where you just buy the dip, then at that point you can. But we're a long ways from that point, in my opinion. And by long ways, I mean years from that point. Nonetheless, we'll see what happens from here. But I'm glad you're with me for the 2022 season going into the 2023 season. Let's make it a big year and knock it out of the park. So, happy New Year to you and your family, and let's get to it.